to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. The rules of property investment have changed, and whether we like those changes or not, investors now have to work out how to play the hand they've been dealt. For years, both Scott Aggett and I have been pretty cautious about new property. There are plenty of horror stories: overpriced, off-the-plan stock, huge developer commissions, oversupplied estates, and properties that simply don't perform. But does that all mean new property is a bad investment? And under the new tax rules, could the right new property actually give investors a significant advantage? In this episode of Geared for Growth, Scott and I unpack the case for ready-built new homes versus established property, including cash flow, borrowing capacity, depreciation, rental returns, supply risk, and capital growth. And importantly, we look at where investors can get this strategy horribly wrong. Because as Scott puts it, the tax benefits might improve the numbers, but growth still has to come first. Let's get into it. Scott Aggett, thanks for joining me back on Geared for Growth.
Always love being here, Mike. Thanks for having me back.
Well, we've been having a lot of conversations with guests really since the budget, and I think people are probably getting a little bit exhausted about whether it's a good idea, will it solve all of the problems? But the rules are there, the rules of the game are in play, and it's up to us to analyse them and figure out what is the best pathway forward for clients. And you did that very, very early on. We had some chats about the feasibility of different pathways, and today we're talking about one of them today. And it's not all that you do, but certainly for many of your clients, you're pivoting into the newer build space. So start us off with that. And what has traditionally been your view of new build versus established when it comes to building a resi portfolio?
Yeah, I've veered away from it, is the honest truth, over the years, and probably from a position of denial in terms of that this could be an option that worked for our clients. And a lot of that has come from the horror stories that I've heard throughout the years being an estate agent and also working on the side of investors long term. And much of it is to do with units, and much of it is to do with off the plan. So when we looked at this as a viable option, when the government moved the goalpost, I had to look for where the sweet spot is, right? Like, where is a viable sweet spot? And just like buying established properties, we're constantly challenging our thinking with that of where the best place is to invest, the best asset styles, the best yields, the best overall strategy. So we have to take this seriously. We have to put this into the mix and say, okay, well, the government is pushing us towards a certain type of asset that they want to see investors purchase. There's definitely benefits in doing that in terms of the tax treatment and cash flow and things that we'll unpack here. So what is the best breed, Mike? What is, the viable option for investors to explore? And I guess that's probably where I was able to really learn a lot more about the different options that my clients had and where we thought the best path was for success.
I suppose a bit like myself, when I talk about new, I talk about the horror story and the worst type of new, which is often apartments, high density, often off the plan. But people have held me to task over that. I've had people on the podcast in the past that only do new build house and land package type things, and I have to be fair to them to say, well, I can't categorically say that those properties will never outperform established, because often they can. But let's talk about some of those horror stories. There's a strong narrative that new builds are overpriced, they can have quality issues, they're always inferior for capital growth. How much of that criticism do you think is justified, and where do you think it maybe goes a little bit too fanciful?
Yeah, I think that there's some pretty bad horror stories, and they're justified. Like, if you're buying in these oversaturated investor-based locations, if you're buying into off-the-plan apartments where the collars don't match the cuff, and from that I mean, I worked at CBRE selling off-the-plan apartments at one stage of my sales career, and the rendered images that we were selling up front versus the delivered product 3 or 5 years later was often vastly different as they cut corners for profitability. So that's a risk as well, buying off the plan. You've got developer insolvencies, which is a huge risk as well. We've seen just this week alone, there was some, latest stats that came out from the Master Builders Association about the rate of which builders are going bankrupt. Not just in New South Wales, but right across the country. That number is still really high. Over the last decade, it's been insane. Very sad to see. So there's a risk there in terms of, cost blowouts, time blowouts, or the construction never being finished. But I think it is the developer kickback one for me that has been a really big stigma of why I've stayed out of that space and why a lot of the industry frowns on that market. It's the smoke and mirrors of off the plan sales agents or marketers quoting a price. They've effectively put, let's say a $30,000 to $50,000 premium on that property, which is their commission direct from the developer or builder. And they're stacking that into the price and then trying to say that you're paying the right number. And that's where I've seen a lot of customers over the years come to me saying, look, we've got this noose around our neck. We bought this property and it's taken 2 years to settle. It's now worth less than what we originally paid for it. And they're substantially below what the market is prepared to pay. So part of what we do now in buying these homes is to focus on ready-built assets that are out of the ground to alleviate much of those concerns. And they're priced against established properties that are on the market now.
Interesting. Now, I want to talk about whether you think there are advantages to buying new outside of the tax situation, but the tax is obviously the huge one. You and I had a little bit of a chat about some modelling that we've done that we're going to be sharing later on, and there's all sorts of different variables and levers that you can change, but we took a case study of an $800,000 brand new versus an established property, and over 10 years, broadly speaking, the established property has to provide an extra 1.2% of capital growth to actually be on parity with a new build, assuming the same growth rates. And I've obviously had to massage some numbers around maintenance expenses. So is that really the predominant thing that you're looking for, is that tax situation?
No, I think the tax treatment and the cash flow part of it is the added bonus that never drives the original decision for us. The focus for us, as per your name on this podcast, is growth, right? Like, we've got to focus on areas where we believe we can outperform the market. We've got to invest in locations that we believe are going to de-risk that investment long-term for our clients as well. And then the tax positioning comes into it at a later stage when we look at what type of assets that we can buy within those locations. So we're still really focused first on affordable markets, areas that have, not going to be over saturated with investors. So it's going to be high owner-occupier percentage of ownership. We're choking out future supply. So we're not looking at, endless years of building approvals that are going to continue to create stock in those corridors. We're looking at the right socioeconomic scores in those locations, so the demographics that can afford for those rents to continue to increase and for capital values to increase over time. So there's a lot of different metrics that we're studying here to understand that this is a good place to park your money long term. And we're not looking at markets that are going to be in and out in 2 or 3 years' time. I think if you're going to buy something that's new like this, typically it's going to come with some supply around it as well. So you've got to mitigate that risk. And part of that is holding it long term. So I think if you're buying with a view to selling in 3 years' time or 5 years' time, possibly buying a new house like that in an area where there's other new houses around it is not going to be the right thing to do. You might have to look at an established property instead. So it starts with strategy, but very heavily focused on growth.
That has always been the real risk, is if there's a new build, there's nothing stopping potentially other new builds from hitting the market. That case study is probably turned up to 11 when you think about the greenfield housing estates. Often I like to zoom out on a satellite, and it's great if you can see mountains on one side and an ocean on the other, and you go, okay, we've got constrained supply. Well, just anything that means that there can't be new stuff coming in. So in the locations that you're looking at, like, do we have the risk of paddocks, or is it more the risk of maybe knockdown, rebuild, or subdivisions that can change those supply dynamics?
It's both, to be honest. Like, I think in many of the properties that we've been buying in the last few months, they're what I would classify as infill sites. So, for example, in Gunnedah, where we bought 6 properties there for clients in the last sort of 8 weeks or so, we literally choked out the entire supply coming into that market. So these are infill sites in an established town, 170 years old, Gunnedah, but literally no new supply coming down the pipeline in terms of any building approvals. They're going to compete with that stock. So that's a way to mitigate that risk and buy into those locations. But if we use somewhere like, a Truganina in Melbourne or a Sunbury in Melbourne in the Northern Growth Corridor, then it's surrounded by cow paddocks. So it's a matter of, how that land is going to get rezoned by government, what time frame it's going to be released, what is the underlying demand in those locations as well to mop that up. Sunbury is an interesting one. For one suburb, there's over 1,400 transactions last year. So whilst there's quite a lot of supply, there's an insane amount of demand that's matching that. And the actual days on market is very short. So these properties are selling quickly. But the risk on the ground, Mike, for above and beyond all those things, and they're all very real risks that need to be looked at, studied, and mitigated. The issue that we find is that, in terms of addressing this point about holding it long term and not selling it in a short window, is that the type of buyer that wants to buy that new build house, they will only buy those properties and pay you a price if they can't go and recreate their own version of that for a similar money. So if they've got an alternative where they can, even if it's 2 years old, but they can go and buy a new house or build their own new house with their own finishes and style and floor plan, they will go and do that. They want new. So you've got to kind of hold on to it that they've been established, the property's settled down, the supply risk is gone in the short term. And then those ones I think will, they underpin the value long term, safer to hold.
Yeah, I suppose there might be people listening to this thinking, well, that sounds a little bit like you're paying a bit of a premium for new. And the old adage of driving the car off the lot and it loses 40% of its value didn't really work for property so much, but it does sort of now, because it only gets to be brand new with that tax treatment once, and then for the second purchaser it doesn't have that value. So do you feel like you are paying a premium and there's a risk that this legislation could die in May 2028?
Yeah, well, there's a couple of things for that. First of all, you've got to buy in areas, as I've addressed already, that are underpinned by owner-occupiers. So it's not necessarily that you're selling to an investor. Your exit strategy is that you're selling to a local owner-occupier, and they'll pay a premium to get into the right school zone, the right shops, the right lifestyle destinations like that. And they buy in any market conditions year-round. So that's really important that it's underpinned by local owner-occupiers. The second thing is what we found is these properties that we're buying, very specifically, are what we call ready-built. So these properties are out of the ground, and typically they're on the market, right, with another agent, and they're selling it as an established property. So it is competing with established stock. So there is no sort of premium that you're paying for new build. You are competing against other homes that are a year old, 5 years old, 15 years old in the same streets or in the same suburb at least. So again, that is mitigated there when the properties are on the market, and stress test against those local competing homes that are available for choice. And then the third thing is construction prices, as you well know, continue to increase. So what we're buying for $800,000 today is very likely not going to be $800,000 in a year's time or 18 months' time, because it can't be replicated at that same price as the construction prices continue to increase.
That sort of brings me to an interesting point, and it sort of speaks to the dynamics of the markets and the interplay with construction costs versus established. The feasibilities tend to stack better on new builds when the market is accelerating. And I know you're active in places like Victoria, where that market has done very, very little. So the cost of the land and putting a new build there often won't actually make financial sense because the established stock is a little bit cheaper. Are you finding that in Melbourne? And do you notice the difference in markets that have appreciated rapidly, that the feasibility stacks a bit more?
Yeah, that's an interesting question. And it's suburb by suburb that we have to take that in rather than state by state, right? Like it's very much, distilled down to even certain estates within locations as well, where the land prices may make that work and feasible for the developers to get those deals out of the ground. And it's really interesting, the square metre rates, when you look across different locations as well. Like even in markets like, we're looking at new builds in regional Victoria in Sale, for example, versus Alfreton, versus, say, Warragul. The actual land prices in Warragul are really expensive. And then, you're balancing up then, okay, well, to bring them into affordable price ranges, what's getting cut for those developers to keep them at reasonable prices where there's going to be buyer demand? So are they weaker finishes? Are they smaller homes? So there's a whole heap of different, angles that we're looking at here to see if there's value there. I don't know, to answer your question, though, I don't think I answered it very clearly. We're looking in areas where there's a fairly high land value component. By nature of that, the houses, I think, or the construction quality is the risk, is like you're buying houses that are very cheaply built. So you've got to find that balance between those two as well to make sure that you're buying an asset that's going to stand the test of time and not create you problems post-warranty, down the line when you own it long term.
Let's talk about the tax, and especially the investors that are interested in the new build, because I'm guessing a lot of this comes down to the fact that if you're looking at, let's say, again, an 800K established versus a new, one might cost you $100 a week to hold on to, the other one might cost you $400 a week to hold on to. Is that one of the big motivators, and does that really underpin this whole strategy over and above making sure that if you are buying a new property that it does perform like an established property you would hope to?
The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, well, first of all, I think, and we've seen this in the industry a little bit in the last couple of months as well, that certain buyers agents are tweaking the modelling to show that established is going to outperform from a growth perspective and also potentially from a rental perspective day to day as well, which I think both of those things are very misleading and stacked in the favour of whichever narrative that particular buyer's agency is pushing. So when we looked at your modelling, and we did our own as well, we're working on the proviso of 6% per annum house price growth. Long term, we're projecting at that number. And then we're looking at like-for-like rentals, even though you've recently produced a report that might state or challenge that thinking that it may be, 3 to 5% in the favour of a new build in certain locations across the country. So there might be a slight premium there or a bump for the rental returns as well. So when you put those things on an even keel and you model it out, it does become then a big deal of difference in terms of the true cash flow to hold that property day in, day out. Now, why this is important to us is because when these announcements were made, we went back and talked to a lot of our customers that had just bought established properties that were currently in the system to buy right now. And then we were talking ongoing to all future customers that they were coming in around what they can afford for out-of-pocket expenses. And what we found, and I don't know if it's just our customers, but it'll be a little bit ironic if it's just us and nobody else. So I think this is probably going to be felt right across the industry, is that our clients are saying they can't afford to stack all of their losses against this gain at time of exit or sale. They need to have that tax refund year to year to make that feasible for them to hold those properties. Now, in addition to that, the mortgage brokers that we're dealing with are saying that the people that are buying established properties are going to have a 15 to 20% reduction in their total borrowing capacity based on the majority of what the major lenders are doing. So you're going to be, restructured in terms of what you can afford to buy. And then you've really got to be in a position where you can hold those out-of-pocket expenses. And our clients were saying no and no to those two things, which further lent into the importance of how these tax tax benefits are impacting investors.
One thing that I think has maybe not broken in the media as yet, and I'm going to hopefully try and fix that, and you'll be involved in that as well, is you talked about the immediate losses versus the offset on sale, right? So if you make a loss on your investment property in the old system, and in fact, even until June 30, 2027, you can adjust your tax payable and reduce your taxable income. So you're getting that benefit straight away. And a lot of commentators have said, well, this is a little bit just like how family trusts work now. You don't get the deductions that financial year. You kind of hold them as quarantined against future losses. But in a lot of the modelling that I've done, the losses are actually to the point where there'll be zero CGT payable, which sounds really good on paper. But often, depending on the length of ownership, the losses are actually a lot more than the CGT payable. So you're not actually necessarily able to get the exact same amount of deductions on the new system as you are the old system. Do you think that's something that people have thought about much or would understand?
No, and I think that's why your modelling is going to be really important to bring that to light and to show people what this looks like over a 5-year, 10-year, 20-year hold, and how those out-of-pocket expenses are really going to hurt their, either building their portfolio because it's going to impact directly their back pocket year to year. Now, if you're looking at that $800,000 house and we model out, as we've done with your calculations, then, when you put in the depreciation that comes in year one and you've got a really clean schedule for 40 years in terms of, depreciation, It's a huge difference in year one, and then that just continues to grow and compound over the length of time that you hold that property. It could be as much on an $800,000 house as $19,000 out of pocket year one, and that continues to compound over time. So it's a substantial difference.
Yeah, and one thing I think people might need to take some time to think about is that getting the deductions now versus getting them when you sell, let's just say all those deductions are available when you sell, they're not worth the same. And what I mean by that is that, of course, the time value of money changes. If you're holding it for 10 or 20, 30 years, a dollar is not going to be worth today what it is in 10, 20, 30 years' time. But also, the hardest time to hold an investment property is going to be at the beginning, right? Because over time, you might pay down some principal, but you would certainly expect rents to increase. And we've already seen a lot less participation in the market, both owner-occupiers and investors. Tim Lawless presented at the REBA conference last week that he expects that investors represent around about 40% of all real estate transactions. He expects that to drop to 20%, because it's that upfront cost, that little period at the beginning. How do you think that's going to play out with the market and just the affordability and the sums that people would need to do that maybe would make them realise, gosh, new is maybe the only pathway for me to participate. Otherwise, I've got to look at alternative assets.
That's 100% been the outcome from us when we've been interviewing our clients and talking to them about it in an open manner. And we had to do that to really understand the out-of-pocket expenses and how that was going to impact people, impact people's day-to-day life. And that answer was really clear and loud to us, that they want to retain that negative gearing, and they want to be able to retain their full borrowing capacity so that they can continue to build wealth. So this has been really, an easy sell. We're not selling it to them. We're explaining to them the different options, but it's easy for them to grasp that, because they can see it in a cash flow analysis and it stands out like dog balls, that it's the right fit for them to move forward, and it allows them to continue the lifestyle they want and to build wealth. So pretty straightforward decision when you look at it from that perspective. That being said, it's not for everybody, right? And I think we started with this as well, that there's negatives in buying this. You can get this horribly wrong if you take certain rabbit holes when you're buying new product and the wrong asset type. You've got to go in with your eyes wide open, and you've got to do your homework, and you've got to weigh it up versus established as well, so that you're making a legitimate, educated decision as to what's the right fit for your financial circumstances.
Yeah, absolutely. You pulled me up on something where I talked about the second-hand value of a new build. So if you're buying it brand new and you sell it to me second-hand, it's got much more value to you because of the tax treatment than me. But a lot of people don't understand that really, long-term average, 70% of those purchases are actually by owner-occupiers rather than investors. And I think nothing has really changed in the sense that a good quality investment property is something that appeals far more to owner-occupiers than it does investors. How are you making sure that that's baked into the assets that you select and the locations that you select, that it will actually appeal to owner-occupiers, so you're not just zeroing in on whatever 20, 30, 40% of purchases?
Yeah, that's a really good question, actually. And I think that's a key part of what an expert buyer's agent should bring to the table, is you're looking through the lens of an owner-occupier at all times to buy homes that are really desirable. And, having been doing this for over 30 years and sitting in that agent seat for so long, for decades myself, I understand the right street appeal, the right aspects, the right floor plans and layouts, how the room sizes and storage and things make an impact on people, natural light, ceiling heights, the level of quality in terms of the fixtures and finishes, positioning within the suburb as well, like proximity to parks, schools, transport, lifestyle. Those types of things are really important. So these are all the metrics that we're looking at ensuring that we're getting it right, because we know that the likelihood is, when you're in exactly that, the 30% investor-owned market, 70% owner-occupiers, that your likelihood is going to be that it's an owner-occupier that's going to buy it. Now, they're attracted to those properties as well because they're buying something that has got less expenditure risk for them. They don't have to, update kitchens and bathrooms and roofs and fences and those types of things. They want set and forget properties as well because they're busy with life and family. They really love nice new or modern kitchens and bathrooms and things like everybody does. It's the same reason why tenants are naturally, pulled to those types of properties versus established properties in the same suburbs often, is because they want new fixtures and finishes. They want things that aren't going to break down. There's less likelihood that you're going to deal with a landlord that's not going to fix your oven or the back fly screen door that's falling off or the air conditioning that's broken, because these things are integrated, they're modern, they're under warranty. It's just a more desirable place to live in. And in certain locations, these houses have been built to the latest building standards, which the established homes are at higher risk of. That's not everywhere across Australia, but in certain locations, there's obviously more, weather issues that might impact that local market. We're talking about heating and cooling and things like that have been built to the latest possible specifications. And then when you're dealing with that as an investor, you've got to meet certain criteria in different states as well to make sure that those properties are of high standard and applicable for rental accommodation. So another win for buying new.
Yeah, and that's been a big cost impost in Victoria, right, with their minimum standards legislations, which has just been one of a slew of legislation changes that I think has disincentivised investors from participating in there. So with these new build properties, I'm presuming straight away there's no arduous minimum standard things to hit because a new build is going to tick that off straight away.
Yeah, and we're buying these properties where the houses are turnkey, the landscape is completely finished, all the curtains and blinds and window treatments and things are included in the sale and installed already. So it literally is turnkey. And when you're buying those properties and they're obviously vacant, they're the first sale, then you've got access between exchange and settlement if you negotiate that to be able to run open for inspections and have that property hopefully leased on day one. And we can match settlement to when there's a tenant moving in, and you can generate rental income immediately without having that risk of a vacancy period. So, there's other pros in terms of utilising that time to find the right tenant.
When we go back to that, as you referenced before, that the research where we analysed 180,000 rental listings and found, generally speaking, that new properties command that rental premium. You wrote a post on Facebook the other day. It's definitely a good read, worth people checking out. You didn't find that to necessarily play out in all of those areas. And what does that tell us about that assumption that new is always going to rent for more, or that renters are going to have to pay a premium?
Yeah, well, I mean, first of all, it was fantastic research because it shines a light on that. And for me, that means, okay, great. Well, we've got some information here and we need to go digging further in each of the markets that we're active in and find out whether or not that's true. Is there a premium there? And is that something that we can inform our clients that they're likely to get a better rent and that makes it more attractive? We're super conservative by nature with our rental estimates. And I think one of the problems with buying new is that most of the real estate agents are full of shit. And by most, I mean 101% of them. So, they'll go in and they'll say, okay, this is going to lease for $650 to $700. We do an internal analysis and we'll say, okay, great, we think it's worth $600 a week. That's what we can bank on that we're going to lease it for. And then we go to an external competing agent and find what they say on the ground. Now, what we've been finding, to address the question that you just said, is if we use Sunbury as an example, because that was what was used in my post the other day against your data that you had done in the report, is that we're estimating, say, $600 a week for those 4 beds, and we're typically getting $630 a week for them. So we're actually getting a bigger number than we're being conservative with initially. And then those yields are way above the typical yield for the like-for-like home in Sunbury. So in the example, we were buying well below the typical 4-bed price, and then we were leasing them for well above the typical 4-bed yield. So the typical 4-bed yield in Sunbury was about 3.45%. And we were getting about 4.4 across our 4-bedroom houses that were brand new. So You could definitely see there was a bump there. So then for me, it was like, okay, well, your data was obviously, incredibly detailed right across the country. Why are we outperforming in that particular location? And what's the driver of that? So we want to go looking for that, answer and looking for that information. And what I think it comes down to is, understanding on the ground where the best locations, as we just addressed in the previous question, are, like what's going to be most desirable to a tenant, and therefore, what's going to be desirable to an owner-occupier at exit. So we're buying in the right estates, we're buying in the right location, we're buying the right land size, the right configuration. And in Sunbury in particular, it's 4-bedroom houses that are most desired and sought online, and they're the most sought for tenants as well. So we buy 4-bedroom houses in Sunbury. Yep. Then we're looking at the right fixtures and finishes as well. So we're getting the right ceiling heights, timber floors, upgraded lighting, all those different things like that are going to be really appealing to an end user. And then beyond that, it's negotiating really hard. So that's something that I've obviously prided myself on for 30 odd years, is being an expert negotiator. So it's buying those properties at the lowest possible price. And then it's using a property manager that you know, like, and trust on the ground, who can really advise you as who the right tenant is going to be and how to maximize that rent return as well, how to market that correctly and find the right person. So collectively, that is allowing us to buy below the typical price and get the better yield, and therefore outperform the data that you had provided. And I think, that's where the magic is in working with the right buyer's agent, is ensuring that you marry up all those things and you can outperform.
Yeah, I'm inclined to agree. I think the data doesn't make sense to you because you're outperforming the averages, and that's exactly what people would pay you to do. So that makes a lot of sense to me. Now, new build has a stigma, has a bad rap for a reason. What are some of the things that you see people can get wrong if they're trying to do this themselves that would make you think, gosh, outside of the tax treatment, or even with that involved, if you're going to buy something like that, you're better off buying an established property?
Yeah, so I think it's buying in oversaturated locations. It's, all investor traffic. It's buying in big strata schemes and apartment plans like that off the plan. It's getting in with developers that have got a bad track record, and you can research the developers and have a look at some products that they've built previously, potentially in the locations you're going to buy before you commit. It's not understanding the right price to pay, like getting caught up in the marketing and paying a premium for the glossy brochure rather than working out what the established alternative is on the ground. It's getting involved in construction loans where you've got the risk of developer insolvency. You've got potential cost and time blowouts as well. And then the big issues that we said is in reverse, what we start with. It's buying in areas that is overpopulated by investors, unaffordable, the yields don't marry up, like in terms of it's not going to rent for the right return that you need. It's in an area that might have a low socio-demographic, which you can't afford for rents to increase and prices to increase. There might be a huge pipeline of development approved lots or apartments coming down the pipeline that's going to make this very difficult to see growth in the short to medium term. So there's lots of areas like that are a concern for me. When you actually get to the property, then it's paying the price that the developer, the builder, or the agent wants without negotiating really hard. Often they'll say, oh, it's a fixed price, this is it, but it's not always a fixed price. That's just a marketing ploy to get you to pay a full number. You've got to treat it like you would an established property. Find comparable sales evidence like a valuer is going to do. As soon as you put pen to paper on buying that property, you're going to get hung, drawn, and quartered by a valuer who is looking at the comparable sales evidence. So you've got to go and do that homework yourself so you're not overpaying. Make sure that you do your building and pest report prior to entering into the contract, if it's possible to do so. Then you can find all of the faults in the property. Mostly they're going to be aesthetic stuff rather than obviously structural issues. Of course, you'd walk straight away if there was any major structural issues, but you need to negotiate those items to be included in the contract of sale, and then ensure before you go and settle that those items have all been rectified and the property is in really good condition. So there's a host of ways that you can get this horribly wrong. You've got to get your smarts on and either work with a company that understands that space really well, or do the homework and look for what those potential red flags are and address all of those to mitigate those risks.
That's a pretty good checklist and some great advice, which we've come to expect from you. We expect nothing less from Scott Aggett coming on the show. I want to give you an option in closing, whether you would like to give us a bit of an analysis of what you think the world's going to be like in the next couple of years, given this major structural change to taxation. Otherwise, if you want to dodge that one, is there anything else that we've missed that you think investors really need to know about the case for new build versus established, and how to actually win in whatever decision you choose?
No, I don't think so. I think we've covered that off really nicely. I think the most important thing is it's not just the tax treatment and the cash flow benefits that should lead you to buying ready built or a new home. It's got to be growth first. I think that's the message that's the most important thing for me, is still focus on those fundamentals. In terms of what's going to happen, who knows? I don't have a crystal ball, and I've kind of given up trying to work out where the market's going to go in the future. We just have to play the ball that's in front of us right now, which is the government's moved the goalposts on those changes. Whether they're going to be in 2 years' time or reverse this in future, who knows? We know that this is a viable path for investors to explore. So we're making the most of that, decision that's been made for us, and we're finding the right path forward for our clients to still win. I think that's all you can do in this moment. I'd like to see possibly rates come back a little bit and some more confidence come into consumers. But I think generally speaking for the market, it needed a reset anyway, Mike. Like we've been both at it for a long time. It's been a super bull run. It's unaffordable in many areas, and it just can't continue to grow at the pace that it was. So I think it's a natural reset. But again, having been through this many times over 3+ decades, this will be a short-term blip in the grand scheme of things. I'm a very positive person by nature with this. I think there'll be a natural reset. Confidence will generally come back once people get an understanding of what's available to them, what paths they can take. And at the end of the day, they're still going to want to build wealth, and this is a viable option for them to explore.
Yeah, that's a great analysis. And I suppose if we do another bit of an end of the day statement, you could say at the end of the day that immigration isn't going to be turned off. We're not going to see a huge amount of new construction happen in the next little while. The RBA has flagged that, well, it used to be the competition for public infrastructure that was stealing trades from housing, and now there's actually a new threat on the horizon, which is the construction of data centres. So we aren't building fast enough. We've got far more demand than we can really house at the moment. That all sort of says to me that, sure, the market may contract 5-10%. It could have 2 years in the wilderness, but the long-term trajectory is there's still an undersupply of assets like that, right?
Yeah, and we're buying in quality locations that you want to be able to hold on to long term. So I'm a big believer in exactly that statement that you just made. Like this is a long term hold. Don't make those short term decisions or reactive decision making. And if you look at those key fundamentals and you get it all right, then this will just wash out over time. We're not building anywhere near enough houses, but who knows whether they're going to be there in 2 years' time or it all gets reversed, Mike.
Well, we'll be back to chat to you whether they do or they don't. It'll be interesting to see how these strategies play out and to circle back and see what sort of growth we can see in a lot of these areas that you're purchasing in, Scott. But thank you for sharing all of those insights.
My pleasure. Thanks for having me again. Cheers, Mike.
Cheers.